man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com, answering more mortgage and real estate questions that have been submitted to me through posts and comments on the videos, along with ones I found on the internet. So if you need any help with a home loan in Utah or Nevada, that's where I'm licensed. I'd love to help you with the purchase or refinance. But let's see how many questions we can get answered today. I like to try to say about 20 minutes or so. And if you do have a question or comment, please post it. I'll get to those in another video. But let's just see if we can dive into a bunch of these. I found a couple really good ones. Here's a common one that I got in a couple different ways. So I'll read the question as it is. It says, does a mortgage loan pay for closing costs? And can you put no money down on a house? So it's kind of a two-part question. But when you buy a home, you're going to have your down payment requirement. Then the closing costs are added on top of that. Now, there's some fees like certain mortgage insurances or funding fees that can be added back to the loan, but almost all other closing costs are typically going to be on top of your down payment. One of the best tips I can give you is to have the sales price include your closing costs, whether you negotiate with the seller or even raise the price slightly. That's a far better way to cover the closing costs than financing them or getting a higher interest rate to pay the fees, or even having to pull out additional money out of your 401 or investments or savings or things like that. A small increase to the sales price to get access to more funds to work with usually is a better way to go than some of the other alternatives. So even if you have to offer a little more to the seller, let's say the seller, you negotiate it down to where the seller needs to net $400,000, then offer 405 and say, okay, I'll give you 405 for the house if you give me back the 5,000 to cover closing costs. That's totally legal. That's a very, very common way to do it. And your mortgage payment will be barely different, but gives you $5,000 more to work with. You can even get up to 10 or 20 grand more as long as the home will still appraise for the sales price. So if it only appraises at 400, you can't raise the price any higher. But it is something where you can build a little more into the price to get access to more funds. You can use those funds to cover closing costs, buy out the mortgage insurance, get your earnest money deposit back, as long as the minimum down payment is covered. That's all you'd have to bring. Now, the second part of this question is, can you do a loan with no money down? Yes, there is loan programs that do allow you to roll the closing costs in. They're just a little bit more limited. You're going to have a little higher rates, a little higher mortgage insurance premiums in those types of loans. So if you can come up with down payment and closing costs or roll closing costs into the sales price, that's where you're going to get the best rates and terms and the least out of pocket as possible. The next questions I got, these were questions that I kind of talked about HOAs. So I got a couple questions about how HOAs work. And HOA is a homeowners association. So there are a couple questions. Let me find them here real quick that I thought were pretty interesting. Okay, so the first one here is, can I buy a home that has an HOA but not have to pay to the HOA? Short answer is no. Once you buy into a certain subdivision that has those HOA fees, those fees are divided amongst all the owners in that homeowners association. So that there might be a common bill. Maybe it's the landscaping for all the common areas. Maybe it's a common insurance. If the buildings are attached or your units are attached, the HOA has to have a master policy on the entire building. That way, if unit A burns down the entire building and there's 7 other units within that building, let's say, or 7 or 8 of them, the insurance at least covers rebuilding the structure. So that insurance premium is split amongst the owners. This also happens a lot when there's only maybe one sewer line, one water line, gas line, or something where it's just kind of one into the building or into the subdivision. The bill just gets split amongst those other homeowners. But I'll tell you this, every HOA has a budget. They say what they spent the year before, what they think they need to spend this next coming year. They'll show you where every dime is going. So you can find out, you can research that. You can see how they manage those funds. And you can also see if there's anything that's coming up. Maybe there's a pool maintenance or road maintenance or the lights. There's lights that are around the subdivision. Maybe they're planning on replacing a bunch of those, and there's going to be this big increase in the expense or the HOA fee. You should be able to know that. But as far as buying a home in an HOA and not have to pay the HOA, the very short answer, and I can't think of a single situation where it would be yes. The answer is no. Once you buy in that subdivision, part of the benefit of being in that subdivision is having that HOA. Let's see what else we got here. Sorry. So I try to just do this as right off the cuff as possible. I don't pre-screen any of these. Maybe a couple that I see beforehand that I want to do in the video, but most of the time I just go right to it. So let's see. Is it possible to get a credit score without paying for it? No. So you can get your credit report, but your actual score, the one that actually will matter. Now you can see these Vantic scores and some of these ones that are guessing what your credit score is, and I've seen them way off. I've seen them close or way off. I mean, people come in here with a Credit Karma or freecreditreport.com that has some sort of score, and they say, "Well, I'm a 720." We pull it's a 640. I can't tell you how many times that happens. And people get pretty deflated when it comes to that. So to actually get your score, there's a cost involved to the credit bureaus. And most of the time, it's a lender that's doing that cost to be able to, as part of the risk management, to find out where your credit score actually is. So there really isn't a way to get your actual credit score without paying for it or without applying for an actual home loan. Okay, can you get approved for a home loan when the house is in a flood zone? Yes, but you have to have flood insurance. If you're in a flood zone, that insurance can be very expensive. There's different types of flood zones out there. But so the short answer is yes, you can get a home loan, but you have to have the insurance. If you can't get the insurance, that's where you can't get the loan, or it has to be a lot more money down, or different types of loans out there. But generally speaking, if you can't get the insurance, the rates are going to be horrible because it's another risk they have to offset with the interest rate. So you can get a home loan in a flood zone. You just have to get the flood insurance. Let's see. Does someone who buys a foreclosed also inherit the previous owner's debt? That's an interesting question. So no, once the property is foreclosed upon, that debt essentially goes with it to either pay off the. So let's say it goes into foreclosure and it sells for less than what's owed. The lender's just out their money. There's still risk involved with doing home loans, especially second mortgages. Sometimes homeowners or mortgage insurance will kick in to help cover some of that loss. But no, the short answer is no. If you buy a foreclosed home, you don't all of a sudden get that person's debt for the good or for the worse. It's not like you just take over that person's loan if it was 3 or 4%. That loan is gone. With the foreclosure, that's cleaning up the title, cleaning up the ownership. So no previous owners, no previous liens, no previous anything can be attached to that property anymore. So the answer to that is no. Let's see. Do you lose interest already paid if you refinance a home loan? In a sense, yes, because you've already paid that interest for that loan. So when you make your mortgage payment, you're covering the interest that's already accrued. So when you make your payment, say January 1st, you're actually covering the December's interest on that loan. So you don't get any credit, or you don't really lose the interest. You paid the interest. So the question again, do you lose interest already paid if you refinance a home loan? Yes, because the interest was on that old loan. A new loan is a new set of terms, a new interest rate, a new loan starting over potentially if you're starting back to a 30-year fixed. So the only way you really don't lose the time that you've been in the home is have the new loan match or be less on the term than the term that you currently have left. But a lot of ways you can save extra money is putting the term back to 30 years. But if you've been paying your loan for 5 or 10 years, you paid a lot of interest on that loan for the first 5 years. So instead of doing a new 30-year fixed, maybe look at doing a 25-year fixed so you're not going backwards on those 5 years. But the short answer is, yeah, once interest is paid, that's the fee associated with having the loan during that time frame. Okay, here's one I get a lot, and I don't know what's out there that people think that they can't. So the question is, can two people apply for a home loan together? Yes. I had a loan application one time that was 6 people on the loan. So you can have as many as you need to. So the way a lender will look at it is whoever has the lower credit score is the one that's kind of the credit score for the entire file. So if you have 3 borrowers, for instance, and 2 of them are 700, 800 credit scores, but one of them is 640, the whole loan, the interest rate, everything's based on the lowest credit score. So in many cases, I've actually taken a spouse off the loan because they don't have any income or assets and they got car loans and stuff that we have to hit for the debt ratio. We take that spouse off, so we only have to go off the one score of the better borrower. Unfortunately, a lot of times the husband will have a lot more debts maybe in his name, so his score is lower, but he also has the income. where the wife doesn't have any income but has a higher credit score. So it kind of works both ways of whether you have both borrowers on there, but you can have as many on there as you want that help strengthen the file. But you can, and then you can still be on the title of the property. So you can still, especially here in Utah, you can be on the title of the property without having to be on the actual loan itself. So there's some protections there. If something happens to your husband or wife or whoever's on the loan, there's still some protections where you're at least still on the house. So the short answer is, can two people apply for a home loan? Absolutely. Part of my job is to figure out what is the best combination of borrower to get you the best possible loans. So let's see what else we got. How are we doing on time? All right, we're doing great. If you have any questions, comments, please subscribe, please comment, and please post, and I'll get them to them on a future video. Let's go to this section here. Let's see. Is it possible to buy land without getting a mortgage? Sometimes this is just semantics on what a loan term is, but most land will have some sort of deed or something that is the securitization, and a mortgage is simply the what we call a securitized loan against real estate. So, short answer, sure, you might be able to get some other type of loan, but realistically, it's still going to be a mortgage. It might be called something else, but it's still what a mortgage is, and that's a loan against real estate. So, yeah. Here's an interesting one. Maybe I misread this. Okay, I have a 15-year-old FHA loan, and I'm 7 years in. I'm sick and tired of paying mortgage insurance. How can I get out of it? I'll be 65 on January 6, 2023. Great. So now we know the age. Boy, 15 years of having an FHA loan and not refinancing it with all the rates and all that kind of stuff. That would blow me away that somebody just didn't want to go through a refi or didn't know they qualified. But short answer, you have to refinance in to get rid of the mortgage insurance with FHA loans. Or you can sell. Obviously, you can sell it. That gets rid of the loan. That gets rid of everything. But if you're trying to keep the home, the refinance is the only way to get rid of that mortgage insurance. But you don't have to have 20% equity or 20% loan to value. There's options where you can pay a small fee to remove the mortgage insurance. And depending on the loan to value, that fee can actually be rolled into the loan on a refinance. So somebody that's waited 7 years had an FHA, that blows me away. With everybody, even their current lender was probably calling them and sending them letters in the mail and their statement saying, hey, let's time to refi, because everybody refied, 12 months ago. I mean, we did, I think I saw a report that we did the equivalent of like 8 years worth of refi in less than 18 months because rates had just gone down so low. So this person just kind of missed the boat a little bit, but the short answer to a question is yes, you can. You have to refinance to get rid of the mortgage insurance in almost every case, and especially FHA. If the value of your home goes up, do you have to refinance it? No, you don't have to refi. The only reason you'd have to refi is if it makes more sense than the loan you have, whether it is getting rid of mortgage insurance, pulling out maybe funds from the equity of your home to pay off a bunch of other debts, lower your term, but you don't have to refi. You've got that loan presumably for a 30-year fixed rate loan. You've got that for 30 years, whether you never touch it again. As long as you make your payment, you can keep that loan the entire life of the loan. The reason to refinance is the benefit of refinancing, but it's not a have to. What documents does a co-applicant need to get a home loan? Very similar to what the original applicant has to do. Still have to verify income, assets, payments, stuff like that. Now, I have had situations where, let's say, a mother and a father co-sign for their child, maybe going to school, and they want to just have a house for them, a rental property, that type of stuff. So in that case, they wouldn't need a job or assets or income, but they still need the credit score pulled. They still need to verify a lot of the same stuff that anybody involved in the loan does. So there's some exceptions if somebody doesn't have a job, like a housewife or a student or a child or something like that that's going on the loan. But if you need the co-applicant's income, assets, or down payment or that type of thing, you need the same documentation as anybody else that's on the loan. Let's see. What happens if you don't pay back a loan or a mortgage? Well, a loan. So most loans are going to be secured against something, whether it's a car, whether it's a house. Revolving accounts obviously aren't, but most loans are going to have something that secures it. So if you don't make your payment, that's what they get to take back. So if you don't make your payment, you don't keep your stuff. You don't keep your car, you don't keep the house. So what happens if you don't make the payment? You don't keep the house. Let's see. Can I get a home loan for renting a house on lease? Um, let's see. Can we get a home loan for renting a house on lease? Depends on the terms of the lease. So I have seen like lease option to buy, or you just basically have to go back to the person that owns the home and work up some other contract to purchase the home, but maybe part of your rent payment was built into buying the house. It depends on if it's a lease to own or a lease option, something like that. But you can't just get a home loan based on just renting the house. You still have to qualify with income, assets, possible down payment, all those types of things. So a lot of times people say, well, I've been paying $1,500 a month for the last 2 years. Does that count towards anything? No, the use of the home, getting the opportunity to have a roof over your head, storing your stuff, not living with your parents. I mean, there's still a benefit to renting, but the sooner you can get into home ownership, I think the better. The sooner you'll build equity, tax benefits, having the pride of home ownership. I don't know if you can quantify that as what that feels like to own your own home. You usually get more square footage, usually get more acreage, you get garages, you get to do more stuff to the home. You can put pictures up, you can change the wall color, you can just do more stuff. And there's a pride in home ownership that I think a lot of renters just don't realize until they become homeowners. That's why you don't see a lot of homeowners go back to renting, because that's one big piece, along with all the financial stuff. Yes, tax benefits, appreciation, all that type of stuff. And really, your home payment is much more consistent with the mortgage than rent. Anybody that's been renting over the last 2 years has seen their rent go up like crazy. But everybody that's had a mortgage has actually seen their payment go down if they were able to refi. And more importantly, it's more locked in. The only things that ever change is maybe HOA a little bit here and there. Taxes and insurance can change a little bit, but it's so much smaller than what rents can go up to. So if you can get into a home, get into a home. I know everybody's concerned about what home prices are going to do. But if you look at the last 30 years, home prices are up 300%. Even counting the '08 correction crisis, we recovered from all of that within a long period of time. And again, you're already going to have a housing expense. Why not own it? Why not have the tax benefits? Why not have the appreciation or turn it into a rental property down the road? So I'm a big believer, obviously, in real estate. I've been doing this a long time, and homeowners win in the long run. I will plant that flag in any decade, any generation. Home ownership wins in the long run. All right, what else we got here? Ooh, let's see. We get maybe a couple more in before we're out of time today. There's a reverse mortgage question. I need to do a video just on reverse, so maybe we'll do that one next time. How soon after buying a house can you get a mortgage? You can literally get one right after you bought a home as long as you qualify. Claiming it as another primary residence is where you're going to run into issues. So that might be what this question is stemming from. So it's a very short question. How soon after buying a home can you get a mortgage? As fast as you qualify, literally the next day. But if you say, okay, I bought this home as a primary residence, and 2 days later, I'm going to turn it into a rental and buy another primary residence, that's when you're going to run into some potential fraud. That's when you're going to run into some issues of getting qualified again, especially with the same lender. So typically they want you in the home 6 months to a year before you turn it into a rental or buy another primary residence. So kind of keep that in mind. The occupancy is probably going to be one of the bigger hindrances, along with just qualifying for a whole nother mortgage again. All right, let's see. Time-wise, let's find one more here. Let's see. How long do you live in your house before you can get a home improvement loan? There's home improvement loans that can literally be the next day. Typically, they want to have 6 months of home ownership before they use the new appraised value. So a lot of times lenders are going to go off the acquisition costs for the first 6 months. But there's a lot of second mortgage, home improvement, line of credit type things. Once you're a homeowner, if the value's there, there's a potential. But it also depends on how much money you put down. If there's not enough equity, you can't just get a home improvement loan that's more than what the home is worth, even if the home improvements really improve the value. Now, I've had people say, okay, I bought it for 3. If I put 50,000 into it, renovate the whole thing, it'll be worth 5. So I need a loan for 4. It doesn't really work that way. A lot of times they're going to go off the current value at the home as it sits, not the value after the improvements. So kind of keep that in mind, especially people that are doing property flipping or buying distressed properties, fixing up and selling them. A lot of those improvement costs are something you have to come out of pocket. And then once you sell that first unit or the first couple of them, then you can kind of build up a kitty that you can use to do the improvements on the next couple homes. There's also private money lending. I do a lot of that as well, where we loan people to do these fix and flip properties. It just really comes down to the deal they're getting at the beginning and how much work needs to go into them to get them back to the point where they can be sold or rented. So I hope you found this information useful. I really enjoy doing these. I don't know how many I've even done now, but I'm going to kind of keep doing them every week. If you have comments, questions, concerns, please post them. I'll get to them in another video. If you need any help buying or refinancing a home in Utah and Nevada, that's where I'm licensed. I'm here in St. George, Utah, Southern Utah, but I do business throughout the state of Utah and Nevada. So if you need help with that, check out my website, ryanbolton.com. We offer home equity lines of credit. We've got great mobile apps, including this fitness app, our financial fitness app that is really cool. It checks your credit scores, helps you balance and track your budgets and stuff like that. That thing's really cool. We're going to be really pushing that over the next couple months, but love to work with you. Thanks for watching the video. Click and subscribe and see you next time.